Inflation in Hindi is referred as Mehengai. We all have been witnessing it every day. Your vehicle fuel that once costed rupees 60, today the same fuel is priced over rupees 100. From vegetables to milk products to electronic items, everything under the sky has become expensive. On the contrary, the purchasing power of the most Indians still remains unchanged. To help us better understand the phenomena of rising inflation, today on board we have Lakshmi Iyer, President and Chief Investment Officer, Debt and Head Products, Kotak Mahindra Asset Management Company. Lakshmi, good evening. Welcome to the show. Let's start with a very basic question because today we are having an inflation classroom out here. So, what does actual inflation mean and how does it really eat on into your investments?
So inflation, in a nutshell, effectively means basically there are multiple goods and services that you are consuming as a consumer, and as the price of each of these goods, commodities, services keep increasing, that is inflation. So that adds to inflation, and the reverse is true when the prices are actually coming down. So typically, the tendency is that when you are as a consumer chasing too much of goods at the same time. So when the demand is more than supply, that's when you have inflation. Also, equally true is that when there is a constrained supply, with the demand remaining constant, so assuming that you are consuming the same amount of, suddenly there is a shrinkage in supply, even that leads to inflation. So effectively, the rising cost of affordability of any goods or services is actually inflation.
All right. Let's talk about the current inflation data. Now, India's latest inflation data presents policymakers with a very tough choice whether to respond to the latest acceleration in retail price gains to a 5-month high with more sizable interest rate increase or pause the monetary tightening so as to allow fragile growth to gain more traction. Now, what, according to you, should be the way ahead? Focus more on inflation or also look at the growth?
Clearly, Kavita, if you look at it from a central banker perspective, it is a major dilemma. And uh, why I call it a dilemma is because, on the one hand, you clearly are an inflation vigilant, and that means you have to ensure, as a central banker, that inflation is well within the threshold or a Lakshman Rekha that you have specified. So that's number one. At the same time, you also need to be mindful of growth. While growth is not entirely your prerogative, it is largely a government's prerogative, but it's important that you have to be mindful of growth. So that is what is grappling central bankers today. On one hand, you have a sticky inflation, maybe static at times right now, especially in case of India, but there are certain components of inflation which are not entirely in a central banker's control, like food prices. Now tell me, if the central banker raises rates, will you or me stop consuming tomatoes, or will a consumer stop eating potatoes? So I think that's the dilemma which the central banker is having today. How do you really respond to a measure like, or a phase like this, where incrementally food prices are contributing to the inflation basket? So yes, it is a tricky situation, but raise rates we must, because if you talk about the mother of all economies, which is the US, they don't seem to be in any mood to pause right now.
Working for them. Now, even veteran fund manager Mark Moby says US interest rate will soar to as high as 9%. Now, what, according to you, will be the impact on the world economy because and the commodities as well? Because he clearly said if inflation is 8%, the playbook says you've got to raise the rates higher than inflation, which means 9% and above.
So, well, he is definitely talking about from a theoretical perspective. Yes,
Sure.
if you really need to maintain the purchasing ability of a consumer, which means he or she needs to have a positive real rate experience. So, if inflation is at 8%, I need to have 8 plus something on my rates, on my savings, on my investments for me to be able to sustain that investment. So I think that's where we are, and hence it is very, very important that US inflation starts firstly plateauing out and then starts receding. unfortunately, so far, we're not really getting that comfort looking at the data, whether it's the high frequency data or the consumption data or the food prices data. We're not really getting that trend. But yeah, it's important to see this receding line of inflation. Else we will really have some trouble, and that can percolate, as you rightly observe, into all asset classes, including commodities and equities.
Do you think, Lakshmi, that the demand and sentiments are actually weak, which is what the Fed wants, and that's great for taming down inflation and rates, but it's obviously adverse for corporate revenues and earnings. But then, looking at the overall picture that's been drawn out so far, how much do you think this rate hike is actually working?
See, it is having its desired consequences in certain sectors. And of course, as a central banker, it is important for you to kind of dampen the consumption in certain places. And it will happen. For example, if you are consistently earning less compared to what inflation is eating out from your pocket, then the tendency for you to make that investment is less, number one. Secondly, if the rates are high or the inflation rates are high and your income growth or your wage growth is not really happening in tandem with that, which is again the case in quite a few economies, including India, specifically say rural India. So then you consume less. But either which ways, I think monetary policy, I would say, is not the only solution. Of course, it is one of the solutions to probably cool off this kind of a sentiment where the demand is also quite high in certain sectors. So certainly, it's one of the factors. I would say it's a hygiene factor or a necessary condition. But there are other factors at play. As I said, global crude oil prices, commodities specifically, also food prices. All of these also tend to have some cyclicality nature. So hopefully even that should play ball along with this monetary decision for us to have the platter to ensure that the trend line of inflation is actually coming down.
Okay, let's talk about dollar. Do you think dollar is the new safe haven now? Rupee depreciation has further disrupted the outlook of price stability. But then, what's the dollar outlook?
The dollar is actually tending to be, as they say, mango is the king of fruits. Dollar is actually tending to be the king of all currencies at the current juncture. In some sense, even if you see gold has not really played its role as a safe haven asset in this in this time of turmoil, especially last 12 months. If you see in dollar terms, the returns are negative. Of course, the rupee returns are positive because of rupee depreciation. So it looks like, and if you look at the Fed funds rate, the projections, what the Fed fund futures are indicating, Kavita, it says that by March end, the possibility of the Fed fund rates touching 5% is quite high. And I don't know whether we'll reach that much or no, but the fact is it can't be ignored. So given that kind of a situation, and the other central bankers not really in a rush to hike rates. Of course, trend is on the higher side. It looks like the dollar supremacy is here to stay for some more time.
Let's talk about bond yields. Do you think a lot of it is actually factored in, and what's the way ahead for them?
Quite a bit of the negative news. If you see, if you look at the Indian bond yield curve, for example, the short end has moved substantively faster than the long end. So what the yield curve, which was a steep plane, has actually become a flat plane. What we call in fund management parlance the bear steepening, because yields have gone up. I think going forward, if the US continues to hike rates, it is quite possible that even US treasuries will start inching up further. Currently, it's at 4%. So we don't rule out a scenario that we can see some pressure building on the 10-year benchmark in India as well. It'll be very graded because there's no real apparent massive supply and there is reasonable demand. But of course, with the banks having a voracious appetite for credit, the credit ratio has actually started picking up. The incremental demand for government bonds may not really be that high. So I think one needs to keep this as a watch factor over and above the fact that the global bond yields, especially the US yields, have not yet settled down. So yes, we could see some pressure in the months ahead on the 10-year benchmark, especially on the yields overall at the long end in India as well.
All right, so that's the entire interest rate and growth prospect trajectory. Thank you so much, Lakshmi, for your time and discussing such a crucial, important topic with our viewers today.